ACCAFR Week 2, Presentation of Financial Statements, IAS 1. This is a lecture on IAS 1, Presentation of Financial Statements. Good day, excellent students. I am the ACCA tutor, Mr. J. Mutimukulu. You can contact me at +2637745963668 or via email at transkylex@gmail.com. Today, we embark on a comprehensive exploration of IAS 1, the international accounting standard that lays the foundation for the presentation of financial statements. IAS 1 Presentation of Financial Statements is a cornerstone in the realm of financial reporting. It is a globally recognized standard issued by the International Accounting Standards Board, IASB, that sets forth the principles governing the content, structure, and form of financial statements. IAS 1 Overview, a blueprint for financial transparency. At its essence, IAS 1 serves as a blueprint guiding entities on how to present their financial information to users. This standard is not confined to a specific industry or the size of an entity, rather, it extends its reach to encompass all entities, ensuring a uniform and transparent approach to financial reporting. It is crucial for companies, big or small, as it provides the framework for effective communication with stakeholders, facilitating informed decision-making. The objective of IAS 1. The purpose of IAS 1, 2007, is to establish the basis for the preparation of general-purpose financial statements in order to ensure comparability with prior periods' financial statements as well as the financial statements of other entities. General-purpose financial statements are financial statements designed to satisfy users who do not need financial reports tailored to their specific information requirements. IAS 1 Paragraph 7. IAS 1 specifies the overall criteria for financial statement presentation, as well as structural rules and minimum content requirements. IAS 1 Paragraph 1, Other standards and interpretations cover the recognition, measurement, and disclosure of specific transactions. IAS 1 Paragraph 3. Examples of other standards include IAS 16 Property, Plant and Equipment and IAS 2 Inventories. Key components of IAS 1, a deeper dive. Now, let's delve into the key components of IAS 1. 1. Content of financial statements. IAS 1 outlines what information should be included in financial statements. A complete set of financial statements includes a statement of financial position, balance sheet, at the end of the period. A statement of profit or loss and other comprehensive income for the period, presented as a single statement, or by presenting the profit or loss section in a separate statement of profit or loss, immediately followed by a statement presenting comprehensive income beginning with profit or loss. A statement of changes in equity for the period. A statement of cash flows for the period. Notes, comprising a summary of significant accounting policies and other explanatory notes. Comparative information prescribed by the standard. IAS 1 Paragraph 10. 2. Structure of financial statements. The standard establishes the order and arrangement of financial statements, ensuring a logical flow of information for users. The sequence typically starts with the statement of financial position, followed by the statement of comprehensive income, changes in equity, and cash flows. IAS 1 requires entities to clearly identify, IAS 1 Paragraph 49 to 51, the financial statements which must be separated from other information in a published document, including the notes to the financial statements. Furthermore, the following information must be clearly displayed and repeated as needed. The name of the reporting entity and any change in the name. Whether the financial statements are a group of entities or an individual business. Information about the reporting period. The presentation currency, as defined by IAS 21, the effects of changes in foreign exchange rates. The level of rounding utilized, for example, thousands or millions. IAS 1 Paragraph 51. 3. Form of financial statements. IAS 1 specifies the presentation format of financial statements, guiding entities on how to categorize items and present comparative information. It emphasizes clarity, comparability, and understandability. Basically, to meet the core objective of IAS 1, financial statements should provide information about an entity's assets, liabilities, equity, income and expenses, including gains and losses, Contributions by and distributions to owners, in their capacity as owners. Cash flows. That information, along with other information in the notes, assists users of financial statements in predicting the entity's future cash flows and, in particular, their timing and certainty. IAS 1 Paragraph 9. Importance of IAS 1, setting the stage for financial reporting. Understanding the significance of IAS 1 is pivotal. It is the linchpin that fosters transparency and comparability in financial reporting. By adhering to the principles outlined in IAS 1, companies can instill confidence in their stakeholders, be they investors, creditors, or regulatory bodies. The standard ensures that financial statements are not mere compilations of numbers but coherent narratives that convey the financial health and performance of an entity. IAS 1 in context, harmonizing with other IFRS standards. It's essential to recognize that financial reporting doesn't operate in isolation. IAS 1 is just one piece of the puzzle. Entities should read it in conjunction with other IFRS standards, such as IAS 2, Inventories, and IAS 16, Property, Plant, and Equipment, to ensure comprehensive and consistent financial reporting. IAS 1 overriding concepts. Let's explore some of the key concepts in IAS 1. First, there's the concept of fair presentation. This is the idea that financial statements should present fairly an entity's financial position, performance, and cash flows. Fair presentation necessitates an accurate representation of the impacts of transactions, other events, and situations in compliance with the framework's definitions and recognized criteria for assets, liabilities, income, and expenses. The implementation of IFRS, with additional disclosure where needed, is assumed to result in financial statements that are fairly presented. IAS 1 Para 15. Another key concept is materiality and aggregation. Materiality means that information should be included in the financial statements if it's likely to influence the economic decisions of users. Each material class containing similar things must be disclosed individually, that is, separately in the financial statements. Dissimilar objects can only be combined if they are immaterial on their own. IAS 1 Paragraph 29. However, information should not be concealed by aggregating or presenting immaterial information. Materiality concerns apply to all aspects of financial statements, and materiality considerations apply even when a standard mandates a specific disclosure. IAS 1 Paragraph 38-31. The going concern concept. According to the conceptual framework, financial statements are often prepared with the assumption that the entity is a going concern and will continue to operate in the foreseeable future. Conceptual framework, paragraph 4.1. IAS 1 requires management to evaluate an entity's capacity to continue as a going concern. If management has serious doubts about the entity's capacity to continue as a going concern, the uncertainties must be disclosed. If management determines that the firm is not a going concern, the financial statements should not be prepared on that basis, and IAS 1 requires a number of disclosures. IAS 1 Paragraph 25. The accrual basis of accounting. Except for cash flow information, IAS 1 requires an organization to compile its financial statements on an accrual basis. IAS 1 Paragraph 27. Consistency of presentation. The presentation and classification of items in financial statements must be consistent from one period to the next, unless a change is justified by a change in circumstances or a new IFRS. IAS 1 Para 45. Offsetting. Assets and liabilities, and income and expenses, may not be offset unless required or permitted by an IFRS. IAS 1 Paragraph 32. And finally, there's the concept of comparability, which means that financial statements should be comparable across time and entities. IAS 1 requires that comparative information about the prior period be given for all amounts shown in the financial statements, both on the face and in the notes, unless another standard demands otherwise. Comparative information is presented for narrative and descriptive purposes if it is relevant to understanding the current period's financial statements. IAS 1 Paragraph 38. An entity must present at least two of the following primary financial statements. IAS 1 Paragraph 38a. Statement of financial position *. Statement of profit or loss and other comprehensive income. Separate statements of profit or loss, where presented. Statement of cash flows. Statement of changes in equity, and related notes for each of the above items. Asterisk if the entity retrospectively applies an accounting policy, restates items, or reclassifies items, and those adjustments have a material effect on the information in the statement of financial position at the start of the comparative period, a third statement of financial position must be presented. IAS 1 Paragraph 40A. Where comparative amounts are changed or reclassified, various disclosures are required. IAS 1 Paragraph 41. Now, watch me as I solve this typical exam question. The following information has been extracted from the books of Proton for the year to March 31, 20 by 9. $000,000. Administrative expenses 170. Interest paid 5. Called up share capital. Ordinary shares of $1 each, 200. Dividends 6. Cash at bank and in hand 9. Income tax. Remaining balance from previous year, 10. Warranty provision 90. Distribution costs 240. Land and buildings. At cost, land $110,000, buildings $100,000, 210. Accumulated depreciation, at April 1, 20 by 8, 48. Plant and machinery. At cost 125. Accumulated depreciation, at April 1, 20 by 8, 75. Retained earnings, at April 1, 20 by 8, 270. 10% loan note, issued in 20 by 7, 80. Purchases 470. Sales 1,300. Inventory, at April 1, 20 by 8, 150. Trade payables 60. Trade receivables 728. 2,123 2,123. Additional information. One inventory at March 31, 20 by 9 was valued at $250,000. 2 buildings and plant and machinery are depreciated on a straight-line basis, assuming no residual value, at the following rates. On cost, buildings 5%. Plant and machinery 20%. 3. There were no purchases or sales of non-current assets during the year to March 31, 20 by 9. For the depreciation charges for the year to March 31, 20 by 9 are to be apportioned as follows. Cost of sales 60%. Distribution costs 20%. Administrative expenses 20%. 5. Income taxes for the year to March 31, 20 by 9 are estimated to be $135,000. 6. The 10% loan note was issued on April 1, 20 by 7 and is repayable 5 years from that date. 7. The year-end provision for warranty claims has been estimated at $75,000. Warranty costs are charged to administrative expenses. Required. Prepare Proton statement of profit or loss for the year to March 31, 20 by 9 and a statement of financial position as at that date.
Okay guys, this question has already been solved for us, so just have to explain how the question was solved. All right, so as you can see, there are certain figures which we have to be uh, taken care of. Okay, for example, if you look at this figure, this is the figure for closing inventory. Why am I saying this is a figure for closing inventory? Because remember, the date here is 31 March 2009, and we are required to prepare financial statements as at that date. Okay, the statement of profit or loss for the year ended 31 March, and the the financial position as at that date. So it means that 31 March is the date for closing inventory. All right, and we were also told that the buildings and machinery are depreciated on a straight line basis using these percentages. For buildings, that's 5%, and for machinery it's 20%. Okay, so which means that you need to apply these percentages on the cost of the building when you want to calculate the depreciation amount uh, to be charged this current year. Okay, um, we are told that there were no purchases or sales of non-current assets during the year. So which means when you create your non-current assets table, you are not going to be worried about disposals and so forth. All right, and the additional information is very important when you are attacking questions like this in an exam. All right, so this information on item number 4, the depreciation charges for the year to 31 March 2009 are to be apportioned as follows. So we are told that 60% is going to go to cost of sales, whereas 20% to distribution costs and 20% to administrative expenses. So if you sum up these percentages, they are going to give you 100%, which means you would have catered for the distribution of depreciation charges. Then income taxes for the year to 31 March 2009 are estimated to be 135,000. So this is your income tax expense that is to be considered in your income statement. Then the 10% loan note was issued on 1 April 2007 and is repayable in 5 years from that date. Okay, so obviously when you see a 10% loan note, it means that you need to calculate the interest expense based on that percentage, which is 10% of the loan amount. So if you go to the question, let me try to scroll back to the question figures on the loan note. Um, this is the loan note amount, 80,000. The loan note, remember, 10% loan note issued in 2007. So which means our interest charge is going to be 10% of 80, which is equal to 8,000. All right, so that's the charge in the income statement. But I'm also um, convinced, or rather I just have to say, I guess that you noted that the interest which was paid was this much. Okay, so that was the interest which was paid. um, but the interest in total, we have discovered that it should be 8,000. However, they paid how much? They paid 5,000. So which means there is an accrued interest. So there is a liability there, which we need to take care of. Okay, there is an accrued interest, which is a liability, a current liability. All right. So those are the figures which I thought needed to be discussed about before I present the answer for you. Okay. All right. Somebody might be asking and say, in terms of the interest, why are you saying that we only have to rely on the 10%? Remember, there is an amortization table to those who have been accustomed to IFRS 9, where the financial instruments, this particular financial instrument, which is financial liability, has to be taken care of using the amortization table. In this case, the presumption is that the amount of loan, that has to be repaid is only going to be based on the principal amount plus the interest. Okay, there are no premiums attached to this particular loan, so which means the amount of loan interest is just going to be based on this particular percentage. And then no much technicalities in terms of the amortization considerations about the issue cost and the whether the amount to be repaid is going to be having some premium charges on top. Okay, so which means the interest amount is going to be based on the 10% um, equal payments of 10% uh, of the principal amount. Okay, so we'll delve much when we come to the topic on financial instruments in our future topics. So don't worry. If you're a new visitor to this channel, please just subscribe to the channel, and then you'll be notified. Subscribe to the channel and click the notification bell so that you'll be notified, or whenever I'll be uploading these video lectures. Okay, when a particular topic of interest comes by, you will also be notified. So subscribe, comment, and share so that we learn together. Okay, so the question, and these are the figures, ladies and gentlemen, and the question, as you can see, for Proton. Now, we are required to prepare a statement of comprehensive income as well as financial position. So, those were the deliberations I thought I need to discuss with you first before I present the solution. Now, this is the solution, ladies and gentlemen. Like I said, remember, as you had in the notes, the narrations at the start of this video, you were told that whenever you are preparing a financial statement, you need to clearly label the name of the company, okay, Proton, and the name of the financial statement is statement of profit or loss, and this one is the statement of financial position. Now, let us first look at the statement of profit or loss. We start with the revenue, okay, a revenue figure. From the question, it was 1.3 million. If you look from the figures there, you can see that this is 1.3 million for sales or revenue. It's just the same, okay, but it's an industrial standard to just say revenue. Okay, that's the modern way of presenting your sales. All right, so revenue 1.3 million, and then the cost of sales. The cost of sales figures, you need to create them. You need to calculate them, to compute them. All right. So you need to use the figures as given, like for example 470, and the 470, ladies and gentlemen, you need to know where it came from. All right, remember, cost of sales, okay, or COGS, is given by opening stock plus purchases less closing stock. Okay, opening stock, opening inventory plus purchases less closing inventory. All right, so our opening inventory, ladies and gentlemen, has to be found from the information given. Remember, in the additional notes, we were told of the closing inventory. So our purchases here were 470. So this is the 470 we saw there. All right, so let us look for the opening inventory. Okay, the inventory at the start of the year was there. So the opening inventory is 150. All right, so that's 150 plus 470 minus the closing inventory of 250 there, as you can see. So that's the amount which is being referred to here. This is the purchases, this is the opening inventory, and this is the closing inventory. However, we also need to add the depreciation amount. This is the depreciation amount because we are told that depreciation has to be distributed as 60% to cost of sales, 20% to distribution, and 20% to administrative expenses. So in the exam, you need to to pay very careful attention to these notes, because if you just ramble through and tell yourself that you have done it, and only to be surprised that you did not do anything. So you need to just be very vigilant as you'll be attempting these questions. Okay, so where did we get the 30? 60% multiplied by 30. Remember, I said that you need to prepare a non-current assets table. All right, the non-current assets working or table. This is the non-current assets table working number 1. Remember, we were given information about the land, the buildings, the plant, okay, and we take the balances, opening balance, that is the cost, brought forward figures 110, 100. These figures are given in the notes, in the question. For example, here, this is the land figure. We are told that at cost, the land was 110. The buildings were 100,000, all give a total of 210. And then we are told that the property plant, the plant and machinery at cost was 125, as you can see here, 125. So these are the figures which we are referring to as cost figures. Okay, here these are the figures: the 110 for land, 100,000 for buildings, and 125 for machinery. Okay, plant and machinery. All right, if you add them across, you will get a total of 335,000. Now, the depreciation brought forward is the accumulated depreciation figure. So we have got 48, 75, and 123. But on land, there is a 0. Why? Because land is not a depreciable asset. Land cannot be depreciated. That's the assumption, the accounting assumption, that land cannot depreciate in value. So if you are my student and I find that you put depreciation on land, then I won't be happy, because you would have shown that you are not paying attention to my teachings. Okay, so I want students who are very serious and who just grasp this concept once and for all, that land cannot be depreciated. Okay, so the accumulated depreciation for buildings, let's cross check that it is 48 from the question. So the buildings, we are told that the accumulated depreciation was 48. This is for buildings. Why? Because land is not depreciated, cannot depreciate in value. Land's value usually appreciates. Okay, it appreciates. That is, it increases with time. All right. Okay, so let's proceed. Okay, going ahead, we were discussing about the cost of sales and other issues, where we say that the cost of sales were determined by the formula opening stock plus purchases less closing stock plus any other adjustments, because as in this question, we need to also factor in the adjustment for depreciation. Remember, 60% of the depreciation was said to be apportioned to the cost of sales. So here we determined that the opening stock was 150 and purchases were 470. As you can see from the figures in the question, this was the 470 for purchases, and for the opening stock it was 150. But we also have to consider the closing stock of 250,000, which was also determined to be part of this as a deduction. And then we also have to add the 60% of the depreciation. Now, for the depreciation, I say that you're supposed to create a non-current assets schedule, okay, which is this one on working number 1. It's given on working number 1, where we have got the land, the buildings, the plant, and then the totals. All right. So now for the depreciation, we are told that I say that for land, you're not going to depreciate the land, okay? But for others, we're told that the depreciation was based on a straight line, and the percentages were given for 5% for the buildings and 20% for plant and machinery. So 5% of the cost of the building is the cost of the building was 100,000 multiplied by 5%, we get a $5 here, I mean a 5,000, and then 20% of 125 for plant and machinery, we get 20%, that's 25,000. 20% of 125, that's 25. So uh, the depreciation in total becomes 5 plus 25, that's 30,000. And this is the 30,000 which is being used for apportionment here. So this is the 30,000 we are seeing on this part. All right. So we are only going to take 60% of that as part of the cost of sales, because the notes had indicated that. From the notes, we are told that the cost of sales, 60% of the depreciation is going to go to cost of sales. Please, in the examination, be careful of the notes to the financial statements. These additional notes are very, very important for you to pass this paper. So 60% of 30 obviously becomes 18. All right. So this is why you see here the figure there. We can cross check the figure using our calculator to see if we are going to get the same figure. We are saying 150. Let me open my calculator as well on my phone here. All right, that's 150 plus, sorry, 150 plus 470 minus 250, the closing stock, plus 18, and we get 388. So this is why we put 388 on this part. But remember, this is a deduction. So cost of sales is a deduction. So we're going to deduct it from the revenue figure of 1.3, and we are going to get a gross profit of 912. Then the distribution expense, we have got the distribution from the information, the trial balance there. Distribution costs were 240, but we also have to factor in the depreciation apportionment. Okay, remember, because we are told that 20% is going to go to distribution costs. So it's 20% of the depreciation, and the depreciation we determined it to be 30 from the assets schedule, the non-current assets schedule computation on working number 1. So so that's 240 plus 20% of 30, and we get 246. Similarly, administration expenses from the trial balance in the question was 170, then plus 20% depreciation apportionment of 30. Okay, and we also have to factor in the warranty costs. Warranty costs were given in the question. Okay, if I'm not mistaken, in the trial balance we had the warranty costs. I'm sorry, here, let me try to zoom out. Okay, let's hope the page won't misbehave. Okay, so the warrant provision. All right, so on warrant provision, we are told that the provision was 90. All right, but let us see how the 15 was determined by. Okay, now if we go to the notes, there is note number 7 here. Sorry, my pen starts to misbehave again. All right, let me try to rectify the issue. Okay. All right, I'm sorry for that inconvenience. All right. All right. So I was saying that on note number 7 here, if you look at note number 7, the year-end provision for warrant claims has been estimated at 75,000. Okay. Warrant costs are charged to administrative expenses. Now, the estimate of the warrant cost was estimated at 75,000. However, the warrant provision, all right, was having an opening of 90, all right, 90,000. So, but this year, remember the warrant provisions, these are just estimation for warrant costs and so forth, right? So, originally we had 90,000 as our opening balance. However, for this year, we expect that the costs are going to be 75,000. So, is this a benefit or a loss to us? Now, if there is a decrease in the provision, then it means that it's a benefit. We are going to deduct the difference from the administration costs because we are reducing the costs. But if it had increased, if it had gone above 90, then we're going to have a problem there. We're going to add. So this is why we are deducting. Okay, so this is why there is a deduction there of 15. Remember, 90 minus 75 is equal to 15. Okay, so this is why they were being deducted there. So 170 plus 20% multiplied by 30 minus 15, obviously you're going to get 161. Then profit from operations, this is the profit you are going to get after effecting 912 minus 246 minus 161, you are going to get 505. Then the interest cost. This is the interest cost we discussed about. Remember, the loan amount was 80 and it was a 10% loan note. So 10% multiplied by 80, that's 8,000. Okay, that's the interest. Remember, interest, the other term for interest is finance costs. All right. So we then have to get your profit before tax, and then we were told that the income tax was supposed to be 135. However, we are going to add a 10,000 there, and let us determine where the 10,000 has come from. Okay, if you look back at the figures in the question, you can see that in the previous year we had an outstanding balance of 10. Okay, this was a cost, an income tax expense last year which we didn't pay. All right, and this year we had estimated that the income tax payable was supposed to be 135,000. This was for this year, so we need to add the previous year amount of 10. All right, because the ZIMRA are going to, the revenue authorities are going to require their money. If we did not pay everything, that liability has to be paid one day. So this is why we have to add the previous year figure, and we get 145,000 there. Remember, this is a deduction, and we get the ultimate profit for the year of 352. Remember, there's a connection. That figure has to be transferred to retained earnings. The 352,000 has to be transferred to this amount. It is going to form part of the retained earnings figure. Okay, it is to be added to the retained earnings figures. We'll talk about that. All right, let us look at this working. Remember, we've got the retained earnings or from prior periods, which are the opening balance, the opening retained earnings of how much of 270, and this figure was reported in the trial balance. Okay, retained earnings here of how much? 270. All right, so that's the figure I'm talking about. So 270 is going to be seen here as the opening balance, and the 352 I had just spoken from the income statement which we have done is here, has to be added there. Then we have to deduct the dividends. If we pay the dividends, I'm going to explain them again after this work, after this example. The dividends are going to be deducted from the retained earnings, from the profits which have been made by the company. Remember, in most jurisdictions, dividends are only going to be paid from the profits which have been sustained by the company. You are not allowed to pay dividends from non-ordinary activities of the business. So you need to pay them from the profits which have been paid, which have been made by the company. So we are told that they paid a dividend of 6,000. For proof, let us go back to the question and you'll see the information. So the dividends are here, 6. Okay, so that's 6,000 which was paid as dividend. So once you get your figures, you then have to, this is the figure you are going to take as your retained earnings closing balance, and this is the figure that is to be reported in your balance sheet, in your statement of financial position, the 616. All right, the share capital you just have to take as it is from your trial balance. That's the share capital. Remember, the first part of the statement of financial position is this one, which talks of the assets. Okay, the assets are grouped as non-current assets and current assets. For the non-current assets, we have got property, plant, and equipment, and this was the figure from working number one. Working number one, which was 182. You can cross check, and this is the 182 I'm referring to. Okay, so and then for the current assets, we have got inventory. The inventory we are going to report here is the closing inventory, the 252,000. Then the receivables and the cash at bank or cash in hand. All right, remember, the bank and cash, they can be grouped as one. Okay, so that's part of the asset side of the balance sheet. And the equities and liabilities section is this one. This is the equities and liabilities, where we start with the share capital, the retained earnings, then we move on to the liabilities section. Okay, let me try to change the pen here. Okay, now you can see that the total equity figure is 816. Then we need to add the balance, the non-current liabilities, the liabilities section. So the loan note, we are told in the question it was 80, if you still remember. And the provisions, remember, the provisions have reduced from 90, okay, by 15. Remember we say that this current year they estimated the provision to be 75. That estimate is the one that is to be reported. However, the difference here was actually the 15 was taken care of in the statement of profit or loss. Remember, in our profit or loss, we said that the 15 was a gain. It reduced the administrative costs. So we moved from 90 to 75, which means the 15 was a gain, and it reduced our administrative costs, our administrative expenses. Please, you need to have a sharp mind to remember this. Now, so it means that our total non-current liabilities are 155. All right, so in terms of international standard IAS 37, okay, IAS 37, provisions, contingents, liabilities, and contingent assets, it says that warrant provisions are treated as non-current liabilities. Okay, Then the payables. For the payables, we have got the ordinary 60 as reported, the trade payables. We've got 60, all right, if you still remember, trade payables, sorry. The trade payables, I think they're on this page. Yes, we've got 60, all right, but we also have to consider the accrued interest. Remember, the interest according to our computation was how much? The interest was supposed to be 8,000, but from the trial balance we paid 5,000, which means we have got a liability, an outstanding amount, an interest payable of how much? We've got an interest payable of 3,000. Okay, so this is why we have got $63,000 there. If you don't take care of that 3,000, your balance sheet is not going to balance. Then the tax liability is going to be 135. Are we together? All right, so this is the tax liability that has to be recognized in our records. So if you add up 63 plus 135, you're going to get 198. And if you add them up, this figure and that figure plus the equities figure, remember the equity figure here of 816, then we're going to get 1,169. And this is the same figure which is shown by the total assets. This is called total assets. Total assets include non-current assets and current assets. I'm sure we are together there. Okay, so basically we have done the statement of profit or loss and statement of financial position for Proton. If you have any challenges, please don't hesitate to contact me. All right, these are my numbers as you can see on the screen. If you have got problems with your eyesight, it's +263 774 596 368. Okay, the name is Jerry Timkulu. So please just watch the video to the end. Don't forget to share this video, to like it. Okay, don't forget to like the video, to subscribe to the channel, and to click the notification bell for future videos of the same quality. All right, so let's continue watching the video to the end.
Here are further examples to deepen our understanding of the concepts. Assume a company issues new shares during the year. How should the proceeds from the share issue be classified in the statement of financial position? Should it be classified as an asset, a liability, or as equity? The answer is equity. The proceeds from the share issue should be classified as equity, specifically as share capital within equity. This is because when a company issues shares, it is receiving cash in exchange for a portion of its ownership, and this ownership is classified as equity on the statement of financial position. Remember, equity is the residual interest in an entity's assets after deducting its liabilities. So, the cash proceeds from the share issue are essentially an increase in the company's equity. Great, we got into the groove of this example. Now, assume that the company also repurchases some of its shares during the year. How should the cash outflow for the share repurchase be classified in the statement of financial position? Should it be classified as an asset, a liability, or as equity? I understand that this one is a bit tricky. The answer is that the cash outflow for the share repurchase should be classified as a reduction in equity. This is because the repurchase is essentially a decrease in the company's share capital. While it does involve a cash outflow, it's not the same as paying off a debt or acquiring an asset. Instead, it's a change in the ownership structure of the company, so it's a movement within the equity section of the statement of financial position. It's still equity. Does that make sense? Good. I'm glad that's starting to make more sense. Let's try another example to cement the concept. Imagine that the company pays a dividend to its shareholders during the year. How should this cash outflow be classified in the statement of financial position? Sure, I'll walk you through it. In this case, the cash outflow for the dividend should be classified as a reduction in retained earnings, which is a component of equity. This is because dividends are a distribution of profits to shareholders, and they reduce the retained earnings that have been accumulated over time. So, even though cash is leaving the company, it's not a movement between assets, liabilities, and equity. Instead, it's a change in one component of equity, retained earnings. So, it's still equity, and the reason why the transaction is captured through the statement of changes in equity, SOCI, when reporting. Does that make sense? Now, one last example. Let's imagine that a company issues a loan to another company. How should this transaction be classified in the statement of financial position? Is it an asset, liability, or equity? When a company issues a loan to another entity, the transaction is typically classified as an asset on the statement of financial position. Specifically, the loan is recorded as a financial asset. Here's how the classification breaks down. 1. Asset. Loan receivable. The amount of money the company has lent to the other entity is considered a financial asset. It represents the future cash inflows, principal and interest, that the lending company expects to receive from the borrower. 2. Liability, from the perspective of the lending company. None. Issuing a loan doesn't create a liability for the lending company. The liability is on the borrowing company's side as they are obligated to repay the loan. 3. Equity, from the perspective of the lending company. None. Similar to liabilities, the issuance of a loan does not impact the equity of the lending company. The loan represents a financial asset that will generate future cash flows. In summary, when a company issues a loan, it's considered an asset transaction as it represents the company's right to receive future economic benefits in the form of principal and interest payments from the borrower. Is that clear? I guess so. In conclusion, IAS 1 serves as a guiding beacon in the intricate landscape of financial reporting. By providing a standardized framework for the presentation of financial statements, it empowers entities to communicate effectively with their stakeholders. As aspiring accountants and financial professionals, a solid understanding of IAS 1 is foundational to navigating the complexities of financial transparency and ensuring that financial statements tell a clear and accurate story. As we continue our journey in the world of international financial reporting, remember that IAS 1 is not just a set of rules, it's a commitment to transparency, integrity, and accountability in financial reporting. Thank you for your attention, and may your exploration of IAS 1 be both enlightening and enriching. To those in need of further help in their ACCA studies, please get in touch with me on +263 77459 6368 or email me at jmotemukulu@gmail.com. Have a wonderful day.